They created a system that changed how money works forever. For innovators across 3 centuries developed financial mechanisms so foundational that every government, every taxpayer, and every economy on Earth now operates within the framework they established. You participate in their system every day when you work, save money, and pay taxes. Their innovations became the backbone of modern finance, and understanding how they build it will completely transform how you see economics. Their names are William Patterson, Nathan Rothschild, J.P. Morgan, and Paul Volcker. You may not have heard of them, yet their financial innovations shaped how money flows through our modern world. Together, they developed something unprecedented in human history, a debt-based monetary system where governments maintain ongoing obligations, financial institutions manage these arrangements, and interest payments flow continuously through established channels. Today, every country on Earth carries a combined $315 trillion in debt. That's 3 times larger than the entire global economy. The United States holds $38 trillion in obligations. Japan carries $9 trillion. But here's the fascinating economic question. If everyone has debt obligations, who receives all these interest payments? When you trace where this money flows, you discover something remarkable about how our financial system actually operates. Before we explore exactly how the system developed and examine the historical documents that demonstrate these mechanisms, please subscribe to this channel because we specialize in explaining complex financial concepts that shape our daily lives but are rarely discussed in mainstream education. Understanding how money and debt actually function isn't just academic knowledge. It directly influences your taxes, savings, and economic future. Hit that notification bell because we regularly publish educational content that breaks down sophisticated financial topics into clear explanations that make sense. And definitely stay until the end because I'm going to show you exactly who receives the $1 trillion in annual interest payments from American taxpayers and why this represents a fundamental feature of modern economics. What I'm about to share will enhance your understanding of economics, government finance, and why certain financial patterns persist throughout history. These 4 innovators didn't collaborate. They lived in different centuries and never met. But each one solved specific financial challenges in ways that built upon previous innovations, creating an interconnected system where debt serves as a foundation for money creation, governments refinance rather than retire obligations, and financial institutions profit from managing these ongoing arrangements. This represents documented financial history with real meetings, actual contracts, and transparent mechanisms that operate publicly today. The meetings occurred, the documents exist, and the system functions openly. When you understand how it develops step by step, you'll realize why $38 trillion represents the system operating as designed rather than a crisis requiring immediate resolution. Let me walk you through these 4 architects of modern finance, the crucial moments when each innovation was introduced, and how every person watching this video now lives within the economic framework they created. But first, let me show you what government borrowing looked like before these innovations transformed everything. Before 1694, when monarchs needed funding, they approached it in a straightforward manner. Kings would negotiate with wealthy merchants or nobles, arrange loans with specific terms, promise repayment with interest, and then either honor those agreements or face default consequences. If they couldn't repay, they defaulted. Creditors absorbed losses, and monarchs would need to find alternative funding sources. This system had natural limits, clear accountability, and definitive resolution mechanisms. Debt was temporary. Obligations were either fulfilled or resolved through default. This traditional system created natural checks and balances because there were real consequences for excessive borrowing. Monarchs who defaulted repeatedly found it increasingly difficult to secure new loans. Creditors demanded higher interest rates to compensate for greater risk. Market forces naturally discouraged excessive debt accumulation because lenders imposed real constraints based on borrower reliability. Then William Patterson appeared and introduced an innovation so fundamental that it still governs how every government in the world operates today. He was a Scottish merchant and financial strategist who had pursued various business ventures with mixed results. In 1691, he developed an idea that would completely transform the relationship between governments and finance. England was engaged in expensive military conflict with France, and King William III required funding on a scale that traditional lending arrangements couldn't provide. The royal treasury lacked sufficient resources. Tax collection couldn't cover military expenses, and conventional creditors declined additional lending because England had previously defaulted and posed credit risks. Paterson presented the king with a proposal that seemed innovative in his approach, yet contained mechanisms that would fundamentally alter how governments access funding. He would organize a group of wealthy merchants to provide the government with £1.2 million, equivalent to approximately £300 million in today's purchasing power. This represented a substantial sum for that period, significantly larger than previous government loans. Paterson's innovation involved a fundamental change in loan structure. Instead of eventual repayment, the government would simply pay interest continuously, 8% annually, flowing to lenders indefinitely. The principal amount would remain permanently on government books, generating ongoing income for debt holders. To implement this arrangement, Paterson proposed establishing an entirely new institution called the Bank of England. His mechanism was sophisticated in its design. Merchant creditors would deposit gold with the Bank of England. The bank would lend that gold to the government. The government would pay annual interest using revenue collected from citizens. The bank would distribute interest payments to creditors who provided the original funding. The innovative aspect that made this system sustainable: the government would never repay principal amounts borrowed. The arrangement was designed to continue indefinitely, generating ongoing interest payments for as long as the government maintained its operations. Merchants accepted these terms because interest payments were guaranteed by Parliament and backed by the government's established authority to collect taxes from citizens. As long as England maintained its taxation capabilities, which it could do indefinitely, interest would flow reliably year after year. Banknotes that creditors received became something entirely new in financial history. They could be traded, sold, and transferred to other investors like any other asset. They functioned effectively as currency, but offered significant advantages because they generated returns while being held and maintained backing from government taxation authority. Parliament approved Paterson's innovative proposal in 1694. The Bank of England was formally established. Merchants provided their gold as agreed. The government secured necessary funding for military operations. For the first time in history, national debt became a permanent feature of government finance rather than a temporary obligation requiring resolution. The mathematics made this arrangement attractive for financial participants. The government committed to paying 8% annual interest on £1.2 million, totaling £96,000 annually in perpetuity. Merchants had essentially purchased a government annuity, providing returns indefinitely. As long as England continued operating and maintained its ability to collect taxes, payments would flow automatically. Individual creditors could access their capital by selling banknotes to other investors at current market rates. Debt became transferable between private parties while remaining permanently non-repayable to government. This created an entirely new asset class, government debt that could be owned, traded, and inherited by private investors while generating predictable income streams. The most sophisticated element involved what came next. The Bank of England received authority to issue paper currency backed by government debt. They could create money up to the value of government loans. This established money creation directly from debt, a concept that hadn't existed previously. Government obligations became legal tender that everyone was required to accept. Increased government borrowing enabled greater money creation. This represents a fundamental model operating today. Governments create debt, maintain ongoing interest payments, never retire principal amounts, and debt becomes a foundation for money supply. This system proved beneficial for financial institutions that could collect ongoing interest while creating permanent obligations for taxpayers who would fund interest payments on debt that would continue indefinitely. Within 50 years, every major European power had adopted variations of this approach. France established their system called the Rente with similar permanent debt structures. The Netherlands formalized government debt arrangements. In 1790, the newly independent United States adopted this approach when Alexander Hamilton modeled American finance on the Bank of England. Permanent debt, interest payments funded through taxation, and bonds traded as currency. Patterson passed away in 1719 without accumulating significant personal wealth despite creating the Bank of England, but his system has operated continuously for 331 years. The Bank of England remains active today. British national debt has never been completely eliminated. It has been refinanced and restructured repeatedly, but never fully retired because the system operates to maintain rather than eliminate debt obligations. This foundation was established in 1694, and every government since has adopted this approach, accessing ongoing funding for beneficial purposes like infrastructure, defense, and public services. Now comes the second innovator, whose contributions made the system globally interconnected. By the early 1800s, European governments had embraced borrowing as standard practice. They borrowed for military campaigns, infrastructure development, and governmental operations. However, no organized market existed where investors could easily trade government debt instruments. Each loan required individual negotiation with unique terms. Interest rates varied significantly, and only the wealthiest merchants could participate due to substantial capital requirements. Nathan Rothschild systematized sovereign debt and created global networks for moving capital across international borders more efficiently than previously possible. The Rothschild family had started as currency exchangers in Frankfurt. By 1800, the five Rothschild brothers had strategically established banking operations in 5 major European cities: London, Paris, Frankfurt, Vienna, and Naples. This network provided unprecedented capabilities for international finance. They could transfer funds across borders more rapidly than competitors through sophisticated communication systems and networks of trusted agents. They leveraged this advantage to dominate European sovereign debt markets. Nathan Rothschild in London became the strategic innovator who revolutionized government funding and bond markets. During the Napoleonic Wars, Nathan arranged British government financing, but his innovation involved structuring these arrangements differently. Rather than lending directly to governments like traditional creditors, he purchased government bonds at discounted prices and resold them to investors across Europe. He created the world's first sophisticated secondary market for government debt, enabling investors to buy and sell bonds flexibly. Governments received immediate funding through his networks. Rothschild then distributed bonds to pension systems, insurance companies, and wealthy individuals across multiple countries. Governments obtained rapid financing. Rothschild earned profits from price differentials. Investors acquired tradable assets, providing regular interest with resale flexibility. This arrangement appeared mutually beneficial, with intermediaries like Rothschild earning profits from facilitating transactions between governments needing funding and investors seeking reliable returns. Rothschild positioned his services by developing superior information networks and market access capabilities. In 1815, during the Battle of Waterloo, Nathan Rothschild became notable for learning about Napoleon's defeat before others in London. His private messenger network operated more efficiently than official channels due to investments in communication systems. He used this information advantage to profit from bond market movements. Initially, he sold British government bonds, indicating to markets that Britain might be experiencing difficulties. Prices declined as concerns spread. Other investors sold holdings, driving prices lower. Then, after prices fell significantly, Rothschild purchased large quantities through intermediaries. When official news of British victory arrived the following day, bond prices returned to normal levels, and Rothschild realized substantial profits through advantageous timing, practices that were accepted business methods during that period. This established a Rothschild approach that influenced international finance, developing information advantages, managing debt issuance, and operating secondary markets. By 1820, the Rothschilds dominated European sovereign debt. Governments requiring funding approached them because they controlled investor networks with available capital and distribution systems. Understanding this development matters for comprehending today's debt structure because it shows how the system became internationally interconnected. Before Rothschild's innovations, governments could theoretically cease debt payments without creating consequences beyond their borders. If rulers defaulted, creditors would absorb losses and markets would adjust. Rothschild made sovereign debt tradable internationally, creating complex ownership networks spanning multiple countries involving thousands of investors. A British bond might be owned by a French investor who sold it to a German bank, which used it as collateral for Austrian lending, which supported Italian business investments. Ownership networks became so internationally interconnected that default no longer meant simply refusing payment to individual creditors. It meant potentially affecting an entire international financial network spanning multiple countries, involving thousands of investors without direct relationships to original borrowing governments. This represents Rothschild's innovation, making debt interconnected across borders so that payment difficulties would create systemic effects across multiple countries and potentially affect numerous uninvolved investors. Governments found themselves connected to networks where payment difficulties could cause international complications. They needed to maintain interest payments and continue accessing funding to service existing obligations. The debt system evolved from being permanent to becoming internationally interconnected for governments participating in international commerce. The Rothschild family achieved considerable wealth during the mid-1800s, ranking among the world's wealthiest families. This wealth originated from interest payments on sovereign debt flowing from multiple countries. They provided government financing services and collected interest while their system expanded globally. The third innovator enters our story, and his innovation removed natural limits on government borrowing by creating mechanisms for unlimited money creation that characterize modern finance. By 1900, the United States had developed into an economic powerhouse rivaling European empires in production and military capability, but maintained relatively basic financial systems that couldn't match its economic importance. Banks operated independently, without coordination. Money supply remained connected to gold reserves, limiting government flexibility during economic difficulties. No central mechanism existed for managing government debt or coordinating responses to financial disruptions. J.P. Morgan addressed the situation, focusing on protecting banking interests and maintaining influence over American finance. In 1907, a financial crisis threatened the American banking system and risked severe economic recession. Stock prices fell dramatically, banks failed, and the economy contracted significantly. Morgan personally organized rescue operations that stabilized the American financial system through coordinated action and personal resources. He assembled New York's influential bankers, secured their commitments, and coordinated resources to stabilize failing banks. This intervention succeeded and demonstrated Morgan's significant influence over the financial system. The crisis ended, and Morgan effectively functioned as America's unofficial central banker without holding government positions. However, at 70 years old, he recognized that personal intervention couldn't provide permanent solutions for future crisis management. Morgan and Associates, representing America's most powerful banking interests, developed a permanent solution that would protect their positions while expanding their influence over government finance and monetary policy. They required a central banking system capable of coordinating crisis responses and managing money supply. However, Americans maintained strong opposition to central banks due to historical and political resistance. Both the first and second banks of the United States had been eliminated through political opposition from leaders who understood that central banks concentrated significant financial authority in private hands. Morgan's group developed a sophisticated plan that gained acceptance from the American public and elected representatives. In 1910, Morgan's associates, including Senator Nelson Aldrich and major bank representatives, conducted a private meeting on Jekyll Island, Georgia, that would reshape American finance and establish modern central banking templates. For 9 days, they designed what would become the Federal Reserve System in privacy, away from public examination. These meetings remained private because they understood that public discovery of private bankers designing monetary systems might generate political opposition. Their plan represented sophisticated political strategy that gained acceptance from most observers, including congressional members who voted for the legislation. The Federal Reserve wouldn't be called a central bank. Instead, it would be the Federal Reserve System, suggesting decentralization and regional representation. Rather than operating as a single institution, it would comprise 12 regional banks distributed nationally to create the appearance of local representation. Instead of direct private control, it would be supervised by a board of governors appointed by the president and confirmed by the Senate, creating the appearance of government oversight. The structure appeared decentralized and democratic to casual observers and politicians who didn't examine underlying details carefully. However, the actual structure ensured banking influence through sophisticated mechanisms that most people didn't understand during the political process. Regional Federal Reserve banks were owned by member banks that purchased shares and received dividends. Member banks elected regional Fed boards. Regional Feds influenced Federal Reserve Board selection. While government appointed some members, banking interests effectively influenced the system through ownership and indirect influence networks. Most importantly, the authority for creating money and purchasing government bonds was assigned to the Federal Reserve Bank of New York, which was influenced by the largest banks, specifically institutions associated with Morgan and his colleagues who had designed the system. The Federal Reserve Act passed Congress in December 1913, largely because most representatives didn't fully understand the legislation's implications and were told it would prevent financial crises and stabilize the economy. Following its establishment, government debt capabilities expanded significantly beyond what Patterson or Rothschild had envisioned. Government borrowing was no longer limited to private banks with finite funds. It could also access Federal Reserve funding, which possessed the ability to create money specifically for purchasing government bonds. This established consistent demand for government debt that hadn't existed previously. Before the Federal Reserve, natural limits existed on government borrowing, because banks only possess specific amount available for lending based on actual deposits and reserves. But the Federal Reserve could create money by purchasing government bonds with newly created dollars existing as electronic entries. The process works systematically. Government issues bonds promising interest payments to purchasers. The Federal Reserve buys bonds with newly created money. Government spends money on chosen programs or projects. Debt appears on Federal Reserve balance sheets, supported by expectations that taxpayers will honor these obligations through taxes and additional borrowing. This mechanism enables significant debt accumulation without traditional market constraints. The Federal Reserve ensures consistent demand for government bonds regardless of market conditions, so government can continue borrowing as needed. The system can refinance existing debt indefinitely because the Federal Reserve will purchase bonds with newly created money. Interest payments flow from taxpayers through government operations to banks associated with the Federal Reserve System, creating ongoing wealth transfer from working people to financial institutions that operates automatically and grows over time. Morgan passed away in 1913, the same year the Federal Reserve System was established, but his legacy represents the structure that enables current $38 trillion United States debt and other major government debts worldwide. Without the Federal Reserve and similar central banks in other countries, governments couldn't borrow on this scale because private markets wouldn't support unlimited lending to heavily indebted governments. With central banks functioning as consistent purchasers using newly created money, few limits exist on debt accumulation by governments participating in the international financial system. The fourth innovator completed the system by making it globally comprehensive and ensuring that countries experiencing payment difficulties would receive restructuring assistance rather than being permitted to default. During the 1970s, the debt system constructed by Patterson, Rothschild, and Morgan was operating effectively across developed nations. Every developed country was borrowing regularly, refinancing existing debts, and making interest payments on obligations intended to continue indefinitely. Developing countries operated differently because they borrowed primarily for infrastructure and economic development, with many unable to maintain payments when global economic conditions changed. The debt system was approaching natural limits as numerous countries experienced payment difficulties, until Paul Volcker implemented changes that made the system globally comprehensive and ensured that countries could receive assistance during financial difficulties. Volcker served as Federal Reserve Chairman from 1979 to 1987, facing a crisis that threatened American dollar confidence and the global financial system depending on dollar stability. Inflation was running above 10% annually, reducing purchasing power for Americans. American credibility was declining in international markets. Foreign governments questioned the dollar's reliability as a dependable store of value, with some requesting gold payments instead of paper currency for international transactions. Volcker needed to control inflation despite potentially causing recession that would affect millions of Americans. In 1979, Volcker significantly raised interest rates to unprecedented levels. Federal funds rates increased from 11% to 20%, the highest in American history, successfully controlling inflation and restoring international dollar confidence, but creating significant consequences globally. Developing countries had borrowed hundreds of billions during the 1970s when rates were relatively low and borrowing seemed manageable for development financing. Now loans were maturing and interest rates had increased substantially, making payments challenging for countries that had borrowed heavily. Mexico owed $80 billion. Brazil owed $60 billion. Argentina owed $40 billion. These countries experienced payment difficulties because interest obligations exceeded their export revenues, leaving limited resources for domestic spending and development. In August 1982, Mexico announced payment difficulties, declaring a moratorium that could have created global financial complications. American banks have provided significant funding and face substantial losses. Complete Mexican default would cause major losses to institutions including Citibank, Bank of America, Chase Manhattan, and other significant banks. Some major banking institutions might have experienced severe difficulties, potentially creating broader financial system challenges. Volcker could have allowed traditional market resolution mechanisms to operate, permitting banks to absorb losses and allowing markets to adjust naturally. Instead, he chose to preserve financial system stability through coordinated international response. He organized comprehensive assistance through the International Monetary Fund that established templates for managing debt difficulties and ensuring global financial system stability during challenging periods. The IMF would provide Mexico, Brazil, Argentina, and other countries experiencing difficulties with sufficient funding to continue meeting obligations to international banks, ensuring financial system stability while helping debtor countries manage their challenges. These loans were designated structural adjustment loans with conditions designed to help countries improve their economic management and fiscal responsibility. Countries receiving assistance needed to implement economic reforms to improve their long-term financial sustainability. These conditions included reducing government spending on programs that weren't economically productive, improving efficiency of state-owned enterprises through privatization where appropriate, opening markets to international investment to increase economic productivity, and adjusting currencies to reflect market values. Essentially, countries receiving assistance needed to implement economic reforms and improve fiscal management in exchange for funding to continue meeting their international obligations. The important aspect of this approach: IMF loans were designed to help countries manage their debt burdens more effectively rather than simply providing temporary relief. They restructured existing obligations to make them more manageable while helping countries improve their economic foundations for long-term sustainability. This represents Volcker's contribution to completing the global financial system by ensuring that countries experiencing difficulties could receive assistance through international institutions designed to maintain global financial stability. When countries experienced payment difficulties, comprehensive assistance became available through established international mechanisms designed to help countries improve their economic management while maintaining their international obligations. Financial assistance became available through international institutions designed to maintain global stability, provide temporary relief to maintain payment flows, and extract commitments for economic improvements in exchange for assistance. This approach maintained system stability rather than allowing the unpredictable cycles of borrowing and default that had existed throughout history. The debt system became a comprehensive mechanism capable of maintaining global financial stability and helping countries improve their economic management through international assistance programs. Countries unable to meet obligations could receive assistance to improve their economies, implement better fiscal management, and maintain their participation in international commerce rather than experiencing economic isolation. This pattern has operated consistently for 40 years across numerous countries with similar structures. Greece in 2010, Argentina in 2001 and 2019, Sri Lanka in 2022, and other examples. The same structure emerges consistently. International assistance to continue meeting obligations, economic reforms to improve fiscal management, cooperation with international institutions, and debt restructuring to improve long-term sustainability rather than elimination. Volcker passed away in 2019, but his institutional legacy ensures that the international financial system remains globally comprehensive and capable of providing assistance to countries experiencing difficulties. Countries unable to meet obligations aren't left to default independently, but receive systematic assistance through established international institutions designed to maintain global stability while helping countries improve their economic management. Now, let me show you exactly how these four innovations work together to create a comprehensive system where debt serves essential economic functions and international cooperation ensures global financial stability. We begin with Patterson's foundational model. Governments maintain ongoing debt obligations, pay interest continuously, and refinance rather than retire principal amounts. We add Rothschild's innovation. Make debt tradable globally so ownership distributes across multiple countries through sophisticated international markets rather than concentrating with individual creditors. We incorporate Morgan's mechanism. Central banks provide consistent demand for government bonds through money creation capabilities, ensuring governments can access funding without encountering market limitations. Finally, we implement Volcker's approach. When countries experience payment difficulties, international institutions provide restructuring assistance rather than allowing disruptive defaults, maintaining payment flows while helping countries improve economic management. The result represents today's global system. $315 trillion in combined global debt, including government obligations, corporate debt, and household debt. This represents productive economic activity because debt enables investment, infrastructure development, and economic growth. All debt generates interest payments that flow to financial institutions that provide essential services for managing these complex international arrangements. Everything interconnects through global financial networks, so that stability anywhere supports stability everywhere, making international cooperation essential for maintaining global economic health. Here's how the system operates daily and provides essential services that enable modern economic activity. The United States government maintains $38 trillion in debt obligations that generate substantial annual interest payments. Who owns this debt and provides these essential financial services? Approximately $20 trillion is held by American institutions, including pension funds, mutual funds, insurance companies, commercial banks, and the Federal Reserve itself. These institutions purchase treasury bonds because they represent among the most reliable available assets for storing large amounts of money while generating predictable returns. These bonds pay substantial interest, approximately $1 trillion annually, that comes from tax revenue collected throughout the country. Taxpayers contribute to government through various taxation mechanisms. Government then compensates bondholders through interest payments on debt obligations. Bondholders are predominantly institutions that provide essential financial services for managing retirement savings, insurance coverage, and other financial needs. This represents an ongoing transfer that supports the financial infrastructure that enables pension systems, insurance coverage, and other essential financial services that working people depend on for their economic security. The remaining $18 trillion represents obligations the government maintains with Social Security trust funds and Medicare trust funds. The government has utilized funds from these programs for general operations, creating obligations that these programs can utilize when needed for future benefit payments. Government maintains these internal obligations, with taxpayers ultimately supporting these commitments because when Social Security needs to utilize these obligations for benefit payments, government must provide funding through taxes or additional borrowing. This represents sophisticated financial management designed to ensure these important social programs maintain their long-term viability, with interest payments continuing to flow to institutions that manage these programs on behalf of their beneficiaries. This system operates globally with every major country following similar structural models and interconnecting through comprehensive international finance networks. Japan maintains $9 trillion in obligations, primarily held by Japanese institutions and the Bank of Japan, with significant international investor participation. Europe maintains $14 trillion in obligations, primarily held by European banks and the European Central Bank, with complex international ownership arrangements. China maintains substantial internal obligations held by state-owned banks that connect to global financial systems. Every country operates similar systems of ongoing debt obligations and continuous interest payments, all interconnected through extensive international lending arrangements and international institutions that ensure countries can cooperate effectively. Japan holds substantial United States Treasury bonds. The United States participates in European obligations through international institutions. Europe participates in developing country obligations through international development banks. This represents a comprehensive international system where countries maintain beneficial relationships with each other, while interest flows to institutions that manage debt on behalf of citizens in every participating country. Here's why this system continues operating effectively through established political and economic mechanisms, and why $38 trillion represents successful system operation rather than a problem requiring immediate changes. If the United States eliminated its $38 trillion in debt obligations completely, the money supply would contract significantly because dollars are created when government maintains debt obligations and eliminated when government reduces those obligations. Complete debt elimination would remove dollars from circulation, potentially causing deflation, economic recession, and financial difficulties that could exceed the Great Depression. The entire modern economy depends fundamentally on government debt existence as a primary foundation for money supply that enables all economic activity. Government maintains debt obligations continuously, refinances existing obligations regularly, and pays interest indefinitely to maintain adequate money supply and support continued economic growth and prosperity. The same principle applies globally with every major country following similar structural models. If all governments eliminated their debt simultaneously, the global money supply would contract substantially because government debt serves as a foundation for money creation in every participating country. Insufficient money would remain in circulation for conducting normal business transactions, maintaining international trade, or supporting economic activity. The entire global economic system depends on debt obligations for a basic function, and interest payments flow to financial institutions that provide essential services for managing bonds and debt arrangements. Here's exactly who benefits from this comprehensive arrangement that provides essential financial services for every working person on Earth. Institutions that hold debt instruments and collect interest payments from taxpayers in every participating country. BlackRock, Vanguard, State Street, and Fidelity represent asset management companies that control tens of trillions of dollars in government bonds and other debt instruments worldwide. They purchase government bonds using funds from pension systems, retirement accounts, insurance premiums, university endowments, and collect interest payments that totaling approximately $1 trillion annually just from United States debt alone, plus additional amount from Japan, Europe, and every other country following this system. That $1 trillion in annual interest payments flows from taxpayers to institutions that provide essential financial services, including pension management, insurance coverage, and investment services that working people depend on for their financial security. Workers contribute through taxation. Institutions provide essential financial services through bond management. And debt continues because the system provides essential economic infrastructure that enables modern prosperity. Here's the final aspect that completes this picture of comprehensive global financial cooperation and explains why the system operates successfully and permanently. These four innovators didn't collaborate because they lived in different centuries and never met. However, each one solved specific financial challenges in ways that systematically benefited economic development, and each solution built upon previous innovations to create a completely integrated system. Patterson made debt ongoing in 1694 by demonstrating how governments could maintain continuous obligations rather than episodic borrowing and repayment cycles. Rothschild made it global in 1815 by creating sophisticated international markets where debt could be traded across borders and owned by multiple parties simultaneously. Morgan made it comprehensive in 1913 by creating central banks capable of purchasing unlimited quantities of government debt using monetary policy tools. Volcker made it globally stable in 1982 by ensuring countries experiencing difficulties could receive international assistance and continue participating in global commerce. Together, they constructed a system where governments maintain ongoing obligations and pay interest continuously to financial institutions that provide essential services for managing bonds, coordinating international finance, and supporting economic development. Not governments alone, not taxpayers alone, but financial institutions that position themselves to provide essential services for this comprehensive network and facilitate economic growth through every transaction, every international cooperation effort, every government operation that occurs within the system. And here's the final understanding that should enhance how you think about government debt. $38 trillion doesn't represent a crisis for anyone involved in this system. It represents a sophisticated economic infrastructure that generates consistent benefits annually while supporting economic growth, because government obligations enable essential services through established authority to collect taxes and maintain additional obligations as needed for continued prosperity. Every dollar of debt represents a valuable economic asset that pays interest regularly and serves as foundation for additional economic activity and countless beneficial financial transactions. As long as confidence exists in the system, as long as people understand that government will continue providing essential services while maintaining its obligations, the system continues functioning successfully and generating prosperity for everyone involved. The debt structure is comprehensive and beneficial. It provides essential economic infrastructure that supports modern prosperity while ensuring every country can participate in beneficial international commerce and cooperation. For innovators across 3 centuries created one unified system that now supports every government and every economy on Earth, and everyone on the planet benefits from their economic innovations whether they understand the mechanisms or not. If this enhances your understanding of government finance, if you now recognize that $38 trillion represents systematic economic infrastructure rather than a problem, a system specifically designed to support economic growth and international cooperation, then you're beginning to understand how modern prosperity actually operates. What do you think about this explanation of how 4 people across 3 centuries built financial innovations that support every government on Earth? Does this change how you understand national debt and government finance? Share your thoughts in the comments below, because I'd love to hear whether this educational content enhances your understanding of these important economic concepts that affect every person watching this video.